Welcome to Crescat's Market Call, featuring our macro and activist mining research. I'm Kevin Smith, Crescat's founder and chief investment officer. Before we get started, please read through our important disclosures being shown now. These and additional disclosures regarding the risks involved in the type of investments we will be discussing, as well as the fund's performance, can be found on Crescat's YouTube channel or on our website using the QR codes on the slides. The type of investments discussed on these videos can carry significant risks, including risk of loss. The videos are intended to be general discussions of macro investment themes, the mining industry, and news with respect to the companies in our activist metals portfolio, and are not intended to be investment advice or an offer of investment advice or services. Crescat's managed funds only accept accredited investors, and the discussion in these videos has been prepared with that level of audience sophistication in mind. Any forward-looking statements may or may not come to fruition. If you enjoy our videos, please click on the like button and make sure you are subscribed to our YouTube channel to get notified of upcoming episodes. You can also follow Crescat Capital on X for ongoing macro research and important news updates on our activist metals positions. If you want to learn more about Crescat's investment strategies, we encourage you to reach out to our head of investor relations, Merrick Iwahashi. His contact information is on the screen now and can also be found on our website at crescat.net. All right, everybody. Thank you for joining us here for another bi-weekly Crescat live market call. We've got myself and Tavi, our macro strategist, here today, and Quentin is out in the field up in the Yukon visiting one of our new top secret potential investments. We'll see if it comes to fruition or not, but so he will be joining us in another 2 weeks. Meanwhile, let's get started. So I had a conversation with a Bloomberg reporter, and she quoted me for an article. She's a commodities reporter, and she was asking me about valuations and growth rates for mining stocks, and I said that valuations and growth rates for the large cap mining stocks are better than that on both counts than the AI stocks. And she's like, well, do you have any data to prove that? And well, here it is. Here's the data to prove that. And we're looking at the Mag 9 here. So the Mag 7 plus Oracle and Broadcom, which have kind of been anointed as some of those mega cap AI stocks. And look, if you look at the actual growth rate in the trailing 12 months, year over year, last quarter, last reporting period, and you look across all the Mag 9 stocks, the median growth rate is actually pretty good, 23.9%. Not bad. But the trailing 12-month PE ratio is 38. All right, which you do a PEG ratio comparison. PE is is less than the the PE is higher than the growth rate. So you look at PE divided by growth rate, and it's above 1.6 for a PEG ratio. Now let's look at a selection of the large cap miners. Now these are the large cap mining stocks that are scoring the best in Crescat's quant model right now. So we've got a fundamental equity quant model, something that I've had for like 30 years now. We just continue to update it and upgrade it, and it's a pretty good model. So here we're looking at the top large cap mining stocks in our model, and you look at the median of the actual growth rate year over year in the last reporting period. A couple of these are semi-annual reporting periods, so you got to factor that in, but most of them are quarterly. 129% year over year EPS growth. Okay, now that's why are the mining stocks growing so much on their earnings right now? Well, that's all the operating leverage from the higher gold price environment that we have right now, and it's coming straight down to the bottom line. But what's the PE ratio? The trailing 12-month PE on these earnings. 16 at the median, 16. So you do a PEG ratio, that's 0.13. Compare the AI. Is AI a bubble? A lot of articles starting to go around these days showing that the S&P 500 and the AI stocks, are indeed creating a bubble in the marketplace. Here, here's something that's helping to confirm that. But you look at the comparison of the two median PEG ratios, and it's about a 12 times difference. Okay, so it's about a 12 times better value and growth trade-off in the large cap miners. But what's the problem with the large cap miners? Something that we've talked about for a long time, and that is that these big mining companies are facing a supply cliff, a production cliff. Their reserves, they have not been extending their reserves. They've not been spending the money on exploration and new mine development. That's why we're focused on the smaller cap explorers and at Crescat and the development stories predominantly in our portfolio, because these growth rates are going to be hard to sustain. I mean, sure, if the gold price and silver price keep going up, there's going to continue to be very strong EPS growth going forward, and there's still good year-over-year comparisons too on a quarterly basis. So the outlook for the large cap miners is still pretty good right now, and that's why they're scoring so well in our model. But if you want to look for what we believe is the true growth and value combination that really gets us excited, that's the exploration companies. And let's go on to the next slide. So our, you look at our portfolio, and we have about our activist metals portfolio, which is our largest theme across all of our funds at Crescat today, and we have an entire fund dedicated to that. That's our precious metals fund. It's also the institutional commodity fund, which is predominantly dedicated to that theme as well. But you look at the 78 total positions that we have, and look at across the top of the screen. We're looking at current spot gold prices, current silver prices, and it's still at 82-to-1 gold to silver ratio, which is historically high. It's a very bullish macro backdrop for silver, that along with gold. But we've got 78 total positions in our portfolio across predominantly exploration and development type stage companies, not the big producers like I was showing you. Now, why do we think the growth rates are higher here and the valuations even lower than those large cap miners? Well, it's in large part because of that production cliff, that supply cliff we talked about, where the actual growth at the top line in new resources and new reserves for those large cap miners is just not there. It's why we've had this thesis that these companies are going to need to come and start acquiring the premier exploration companies and development stories if they want to continue their growth. And that M&A cycle, it started to surface a little bit. You've seen some CEOs of the big mining companies who have been criticized, and maybe that's something behind why Mark Bristow, was abruptly retired. He really, along with many other large companies, have not been investing in exploration and have not been investing in acquiring new deposits, new companies with the new gold deposit. So you look at our portfolio. We've got 78 positions across the portfolio. Most of these small cap and some micro cap stocks, but with big target discoveries. We've got, among our portfolio, we got 42 companies that have already made bona fide discoveries. That's using Newmont's criteria of more than 3 100-gram meter drill intercepts on a gold equivalent basis. These are big tier one type targets that we're going after, the type of companies that the majors are going to want to acquire for their tier one discoveries. Most of the companies in our portfolio are private, but about 9 are public rather, but some of them are still private. We've got 19 private companies. We have several of them that we expect to be going public here over the next several months. At the median, we have activist positions across most of these companies. At the median, we own 9.9% of them on a partially diluted basis. That's including warrants, and we've got 116 drills operating right now across our companies. Our companies have 116 greenfield drills operating. That's more greenfield or new exploration drilling than all the major gold mining companies combined. And we have target 312 million gold equivalent ounces of new discoveries. These are based on our geologic estimates. Some of these companies have official resource already, but these are based on our own internal geologic estimates, courtesy of Quinton, based on the drilling progress to date. Our growth targets for these companies are even higher across the portfolio. So why is a portfolio like this more exciting than a large cap mining portfolio today, even with those high growth rates and low and reasonable PE multiples? Well, we think simply because those growth rates are not sustainable with those other companies unless those companies come into the market and start acquiring the companies that are in our portfolio. And relative to our reserve estimates at these companies, we think our portfolio is extraordinarily cheap, much cheaper than the large cap companies, and with higher appreciation potential. If you want to learn more about those numbers and why we feel so confident in them, we invite you to reach out to us for a one-on-one presentation, because it's not something we can go through in a public forum like this. But let's go on to the next. The top 10 stocks in our activist metals portfolio. I'll just go through these real quick. San Cristobal Mining. This one's actually a producing story, a development story, and a new discovery story, all in one. And I invite new prospective clients to inquire about it, because we actually while it's a private investment that's been put into a side pocket, we actually can make it potentially available to new clients as well. Goliath Resources up in British Columbia in the Golden Triangle. They are onto an incredible gold discovery. Sitka in the Yukon, another Snowline Lake gold discovery that is our number 3 position. Tectonic Metals in Alaska, another reduced intrusion gold system. They have a bona fide discovery hole in their arsenal with the drilling that they're doing this year, with assays to come for the next several weeks and months. We think that's a very exciting story to watch here. El Oro, big silver, zinc, lead discovery in Bolivia. Silver Bow Mining, this is a private company that has half of the Butte, Montana mining district for silver and copper. It is their ground, bona fide 43-101 compliant silver resource. This is one that we hope to be getting public here in the next few months. Alaska Silver up in Alaska, another silver, zinc, lead CRD discovery that just had its U.S. IPO debut. It's been a publicly listed stock in Canada. Cantor Fitzgerald just raised a big slug of money for them to have a great continued exploration season here for next year. Altamira, this one is in Brazil, and it's another big gold system that's like a reduced intrusive gold system, but it's different age rocks from those Tintina systems up in the Yukon and Alaska, but just as exciting. Quentin is really excited about the potential for Altamira. I'm sure he'll be talking about it on the next video. Rakla, another reduced intrusion target up in the Yukon gold system. This one has not put out their assays yet, but we hope they are. We're really looking forward to seeing those. And SK Mining, a gold and silver Discovery up in the golden triangle. That is our number 10. I could keep going. We got 77 stocks in the portfolio, but that's all I'm going to talk about for now on these. Let's go on to the next. So why, why is it? We talked about the comparison of valuations and growth rates between the AI Mag 7, Mag 9, what I call the bubble stocks out there, and the miners. And we showed some of those numbers that are irrefutable in terms of growth rates and PE multiples. But why is it a potential bubble right now out there that is poised to burst? Why is this big CapEx boom on the AI front, potentially going to be another one of these cycles like in the year 2000, the Y2K bubble? Well, here, it's the CapEx cycle is what we contend here at Crescat. That's a big driver of this, because these cycles are reflexive. They're things that build on themselves and create their own performance, both for the economy and for the companies themselves. And then they unwind on themselves in self-reinforcing fashion. This is exactly what happened during the internet bubble, the dot-com bubble, and Y2K. And here we're looking at the top 5, the hyperscalers of Y2K, the top 5 companies that were building the internet: AT&T, SBC, WorldCom, and Quest. And these were the companies that were spending the most CapEx in the S&P 500 at the time. And you can see how their CapEx was climbing in 97, 98, 99, 2000. And it peaked. It peaked out. The spending boom peaked and unwound on itself. I mean, everyone thought that because of the internet and what a great new thing it was, that we're just going to have to keep building more and more of the information superhighway. But guess what? We didn't need to build anymore, and companies spent too much. And this you can see in the aggregate market cap of these stocks in the red line here. You can see how it peaked out across these 4 companies. I think 2 of them went bankrupt in the ensuing 2 years. And so why do these CapEx cycles work like that? It's how the world works for cyclical industries, cyclical economies. It works that way in the mining sector too. It's why we've been through a 14-year bear market in the mining sector, one that I think is inevitably determined to turn back up and sustain in a long bull market. Okay, so we've seen what happened to the telecom providers, the hyperscalers of Y2K, right there back in 2000. Let's go on to the next. What happened to the top vendors to the hyperscalers? These might be considered the equivalents of the NVIDIAs and the semiconductor companies today. But back then, who was it? It was Cisco Systems, Sun Microsystems, Lucent Technologies. They were the top 3 vendors, the ones that all that CapEx boom that you saw. Where was that money being spent? Well, it was being spent at these companies here. And they also peaked out in March of 2000, at the peak of the tech bubble, and these companies were decimated in the ensuing 2.5 years. So I think most of us are old enough to remember that one. But let's go on to the next. So now let's look at the top 4 hyperscalers today, and it's just up, 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 up. Is it possible for this trend to continue up, 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 up on a sustainable basis? Or is it more likely to end in one of those reflexive unwindings where things just got too big? How can that potentially happen? Well, it's, when companies are spending so much money on building on CapEx, on building out the data centers and providing the AI services, are they going to be able to get a return on that investment? Are they going to be able to get a return on this highly depreciating computer equipment that they've been buying, and enough to justify continuing to sustain that level of investment. I don't know, but I contend that it's definitely not indefinitely sustainable, and I contend that it's approaching a level that is getting ready to unwind and self-reinforce the other direction. Why, what is one reason for that? Let's go on to the next. One reason for that is that the valuations of these companies and how much money they're spending on this equipment, it's simply unsustainable relative to the size of the overall economy. So we compare the top 10 mega cap stocks of 2000 to the top 10 today. And yes, this chart hasn't been updated in like a year. I need to update it, but what's it going to show? It's simply going to show that this bubble has gotten even larger today. Okay, so the top 10 enterprise value stocks at the peak of the tech bubble, we only reached 28.4. It was 28.4% of GDP before that self-reinforcing cycle started unwinding the other way. Well, a year ago, we gone up to 64% EV to GDP, more than twice as big as that internet bubble in 2000. And here we are today, even higher than this level. So what's the catalyst for it to begin to unwind? I don't know exactly, and I don't care. I know that we have record valuations, and I know that we have an abundance of catalysts that could potentially, be the trigger here. I'm not even going to get into those. I'm sure Tavi will get into a bunch of them. But or it could be some kind of a black swan altogether. An unknown, trigger. And I don't care what it is, but it's something that I want to be positioned for the unwinding of this, and I want to do it in a Nassim Taleb kind of a black swan strategy way. Not just by finding alternative longs to be in, like the mining stocks, but in our global macro and our long short funds. I want to find a way to participate in the inevitable bursting of what I believe is the bubble. Let's go on to the next. So here, we finished another really good month at Crescat in September. So we're showing the performance of all the funds, and we just finished the month, and so I wanted to show our estimated numbers for September. And our global macro fund, excluding the side pocket, up 122% year to date. Our institutional macro fund up 109% year to date. Long short up 121%. The precious metals fund up 120%, and the institutional commodity fund up 110%. Our large cap SMA is up 67%. Our precious metals SMA up 85%. So Crescat is having a great year across the board, but what we've been talking about is why I believe it's sustainable. And now, to get back to this black swan idea and how we're playing it within our global macro and long short funds, let's go on to the next. Well, before we get to that, here we're just showing that according to Preqin, and this is through the end of last month, we have 5 of the top 10 performing hedge funds in the entire Preqin hedge fund database, and this is among 1,374 hedge funds. So our themes are working. The short themes that we have, the black swan themes in global macro and long short, have also been working, because we were able to capitalize on those market dislocations that we had earlier this year, back in February and in April, via our short positions. And we're able to cash in when we had that volatility explosion as well. But here we are at record all-time high valuations again. So we're still our black swan trade to keep the put options alive, to be able to play this inevitable unwinding, is still in play. And that's in the global macro and the long short. Let's go on to the next. Specifically, let's look at the global macro fund, because this is our most comprehensive fund that we have at Crescat, where we can play all of our macro themes. Yes, the activist metals is the largest theme in this portfolio. It's a long theme, but our second largest theme is the what we call the, I forget exactly what we're calling it this day, but it's the mega cap. It's the mega cap bubble, the mega cap tech bubble, and we want to be in it to play the unwinding of this. It's the S&P 500 index fund bubble. It's record valuations that we have, and the abundance of potential catalysts to unwind those. Predominantly through the rising inflation trends that we have, given the unsustainable debt and deficits. But so what is this? What's a negative downside capture ratio? What it shows is that in the almost 20 years of history of our global macro fund, that we have a negative, that in down markets, if you look at all the down months that we've had over that time frame, and this fund was launched before the global financial crisis in 2008, it shows that on average we have gone up in down markets, whether the global hedge fund index has gone down or whether the S&P 500 index has gone down. We're looking at both. On average, we have gone up when those things have gone down. Why? It's because we're not afraid to short in this fund. We're not afraid to play the macroeconomic cycle. We're not afraid to increase our exposures on the short side when we think the market is most at risk of a potential downturn, like we believe today. So let's go on to the next. So this is looking at the global macro fund again, and now we're looking at all hedge funds in that call themselves discretionary global macro in the Preqin database that were around since before the global financial crisis, and this so it includes funds like Bridgewater. Now keep in mind that there were a number of macro funds that simply folded shop and went out of business in that 2008 crisis. More hedge funds went under in that period probably than any other time period in the history of hedge funds. But our fund did not. In fact, we did really well with our housing bubble theme. When we were short Lehman Brothers and Bear Stearns, we did have one of our biggest drawdowns in late 2008, but we came back strong and were one of the top performing funds in that 5-year period since our launch in January of 2006 that encompassed the global financial crisis. So here we're looking at a plot of absolute return. So our average net annualized return since inception of this fund on one axis, on the X axis, or on the Y axis, and on the X axis, we got our downside capture ratio. So we want to be in that northwest quadrant, which shows that, on average, when we have a down market, we can go up. And you look at other funds that also have a favorable downside capture ratio. It's Bridgewater, Pure Alpha 2 and Pure Alpha Fund. They're right there up at the top of this table and in the scatter plot. But the S&P 500, we've been through one of the biggest bull markets, and we're at the highest record valuations I think that we've ever had in the stock market, and so the S&P 500 is looking really good right now. It's got, since inception of our fund, it's got 11% net annualized returns. Okay, it's right up there in the high 10s, almost 11%, just like our fund. But what happens when the market goes down? When the market goes down, the market goes down. So the S&P 500 goes down when the market goes down. On average, and past performance is not a guarantee of future returns, but on average, our global macro fund has gone up when the market has gone down. And I will tell you that we have a robust put option portfolio right now in our global macro fund to play this inevitable downturn. I think more than ever now is the time for a Nassim Taleb style strategy. Now, in his Black Swan book, he would say, well, you got to always have protection for the Black Swan, and there you got to prepare to lose until you have the big dislocation, and then you win on rolling your puts. But I would argue that there's times when you want to dial it up versus dial it down. Now is a time when we are dialing it up, okay, and we are discretionary global macro fund, and yet it's a strategy that where we can have an asymmetric upside to downside dislocation in the stock market at large. It's something that we're employing in our global macro fund, our long short fund, and our institutional macro fund, and it's put option portfolio, and talk to us about how we're schedule a call if you want to learn more about how we're implementing this. But do I have any more slides here, Trevor? Okay, that's it for me. So we're going to flip it over to Tavi, who's got an abundance of really good macro charts to talk through.
Thanks, Kevin. All right, let's get started. Let's see if I'm not muted. Yep, I'm not. Okay, perfect. All right, everyone. I think there's a lot to talk about. I'm going to get, as Quentin likes to say, my skates on. There was a lot of data that came out this week, and especially, I'd say particularly what's happening with labor markets was a big one. We've seen data, I would say, especially in ADP research or reports were very, very negative overall. And I would say the other thing is definitely calling attention is if you looked at the younger population unemployment rates, they're starting to really accelerate to the upside. In other words, deteriorate substantially. If we looked at historically, this is an indicator that tends to actually lead further declines in the labor data overall. And so I suspect that that's showing a lot of issues here. The ISM services that came out today was also very telling. Now I joke here because that's how Jay Powell once said maybe a year ago that he doesn't see the staggered deflation, and so since then I've been obviously paying attention to things that present or show something different, and certainly that's the case with the ISM services. I mean, you can see that the prices paid is about to make a 70 handle, and this is pretty significant. And back in 2021 or so, when we saw something close to this, I mean, we were on our way to a major increase in inflation. So this is not something to be to be fading. I mean, this is a data that you want to be paying attention to. On top of it, if you look at this stuff, there's plenty of other segments of the ISM services that you should be paying attention to. But in this case, given the fact that the Fed has such a strong focus on inflation and labor markets, you can see here that ISM employment is also below 50, of which tends to be recessionary as well. So people are not. It's another report that is separate from the BLS and other things that is also pointing to the direction where there has been some significant weakening in the labor markets, and so something to definitely be paying attention to because that's going to be driving monetary policy. Another thing on the ISM services that I should point out is the next chart, of which it shows business activity and at a 5-year low. Now you can see this trend has been falling for some time now, and continuing to do so. And now it's below 50 for the first time since 2020, and it's certainly something that also adds to the fact that business activity is starting to perhaps even contract. Who knows? There's different metrics you can use for this, but nonetheless, this is an important aspect here. Let's go to the next chart. On the inflation front, this is one of the most important and fascinating macro charts in my view. And the reason why this yellow line doesn't go back further is because the index itself has a history that goes back only to the mid 2000s, as you can see in this chart. And basically, the yellow line is a index that is calculating the equal weighted prices of commodities, and so it includes everything: metals and agricultural commodities and energy and so forth. And you can see that this continues to, just like the ISM prices paid, of which was not quite at the highest level in 2021, but it's been moving higher. It's doing exactly the same thing, right? It's accelerating to the upside. And then you have another metric, which is inflation expectations by the market, which is really investors trying to figure out where CPI or consumer price index would be 10 years from now. And you can see here in this green line that it's been certainly diverging in a way relative to the yellow line. I suspect if you put a gun to my head and say, well, which one should you really trust here? I think that the real world inflation metric is, of course, there's services. There's always going to be a smart butt that will make a comment and say, well, what about services, Tavi? Well, I can even argue that goods inflation can have a major impact on services as well. All these things are linked. You start thinking about companies that increase prices of their goods, it starts feeding into, the process of making those goods, and eventually it feeds into services. And so don't be naive by just saying that there's a major separation between those two. This is real world inflation. This is, how everything is built is basically using some sort of commodity. And so, yeah, you can pick one or two and say, well, this commodity is not rising, therefore we're not seeing inflation. Sure. There's definitely, eggs, for instance, egg prices have collapsed recently. And you can make that case and say that that's the one thing that you don't want to be focused on, or oil, of which I think it's an opportunity, but factually oil has been down. And so, you may say that because of that, inflation is lower. But look at every single metal in the planet today and where it's trading. Look at agricultural commodities. There's a lot of agricultural commodities actually doing very well. So all these things should be feeding into inflation in a certain way. And I do think the green line is lagging substantially what it could happen here with a reacceleration of inflation, especially when you have a government and a Federal Reserve that is being forced into, we used to call this financial suppression, but it really is financial repression. And so we might graduate to what it's supposed to be here. So anyways, let's go to the next chart. Another thing that is very, we can break down our views into structural views and tactical views. Structurally, we can say, I think with a lot of confidence that the market is very expensive. Now, you can use all sorts of metrics to claim or to say that that's been the case. And I have one that is, to me, the most important one of all. Now, you can say market cap to GDP. You can say global market cap to GDP and global GDP as well. You can use fundamental metrics within the markets and say the same. But to me, or positioning as well, right? Positioning is probably one of the most important things you should be paying attention to as well. To me, what I think is incredibly important here is the CAPE ratio, right? It's a cyclically adjusted PE ratio, which basically calculates where prices are relative to an average of earnings per share over the last 10 years. And it smooths out all the perceived volatility that we tend to see in earnings. And it gives you a sense of how much you're paying for those earnings, right? I mean, it's undeniable that you're going to have earnings that are going to be potentially, doing well in this environment. But how much are you paying for those earnings is a key question that I think investors oftentimes forget about. And sure, valuation is also not necessarily the best metric to time something. So here I'm going to attempt to use a few that at least worked for me personally and for the funds in the past. And it reminds me back in 2018 when we saw transportation stocks, and that's a Dow Jones Transport. And transportation, if you don't know, it does have a very strong link with the real economy, right? It's the same way commodities have a real link with the real inflation. I would say transports is a outstanding way to sort of gauge how is economic activity, shaping up. And it's been very, I would say, certainly not confirming this strength that we're seeing in the white line. So you're looking at a chart where the red line is transports and stocks, and the white line is S&P 500, which has been making new highs, and a clear divergence between the two. The last time we saw this was before a correction in the market. If you ask me, I think we're getting ready for another one here, given the positioning that we are and the breadth that has been weakening as well. I'll show you the next chart. In the next chart, you can see here that the S&P 500 versus its own percentage of stocks above 50-day moving average. And you can see that we've been trending lower on that metric as well. In other words, the breadth of the market is weakening. And there's, I didn't use these charts here for everyone, but I will point out, if you do exactly the same calculation using consumer discretionary, which is, as most of you should know, consumption is the most, is what drives the U.S. economy in a large way. So you want to be paying attention to that cyclicality of consumer discretionary as a sector of the S&P. If you look at that versus its own, 50-day moving average, a number of companies that are actually making, above those moving average targets, you can see that actually that one is also diverging substantially. So less and less stocks are the ones really propping up the equity markets in a large way. It's kind of similar to that Mag 7 situation that we saw in the past. And ultimately, what you tend to see is that alligator mouth tend to shut. And so I suspect that the way this is going to shut or close is going to be with the white line having to, go back to reality in a certain way. And so I'm very concerned in the near term. So not structurally. I've just already made the point structurally, but tactically, I think we're gearing up potentially for a correction. That's my view here. That is gaining high conviction actually in markets right now. You can also look at tight spreads. I mean, if you dynamically would, if I had a gun in my head and say, all right, Tavi, you have to dynamically hedge a portfolio, right? Like you just forget about your views and just use a few data points to tell you when to hedge. I think I would say that it's credit spreads. When credit spreads go below 3, you should be hedging your portfolio. That's my opinion. And the second way would be VIX. If VIX goes below 15 or so, your premium, or I should say, the risk in the markets is completely priced out, in my view. And so that's when you tend to see those volatility events. Volatility events don't happen when VIX is too high. Volatility events never happen when credit spreads are very, very high as well. And that's because most of that volatility is already priced in those assets. And so, the risk itself is already reflected in the price. In this case, I think it's quite the opposite. So you want to be paying attention to this. Let's go to the next chart. Next chart to me is it's a global phenomenon happening of where you're seeing all sorts of central banks cutting interest rates. In the last 12 months, you saw 168 cuts. And that is, the last time we saw this was June 2020, after the COVID recession. A bunch of central banks decided to also cut interest rates. After the global financial crisis, you saw the same 249 cuts by October 2009. Okay, that was the high level after the global financial crisis. This time around, we haven't even seen anything, right? I mean, the market is actually making new highs and we're seeing cuts. So what's going on? Well, it's called debt. Most of these countries cannot afford having interest rates at these levels. And what I think it's fascinating by this chart, there's a lot of different conclusions, but I'm going to point out what I think it's the most important conclusion of this chart is the fact that we did see the dollar, declining substantially this year. One of the worst performances of the US dollar since the 1973, I believe. And if you think about it, that's on the back of a lot of easing happening across the globe, not in the U.S. The U.S. actually has been the one that has been more stubborn relative to those other economies when it comes to easing monetary conditions, given the level of leverage that is present in the system. And you can measure that leverage by many different ways. You can look at debt to GDP, which is the most normal way to look at. But to me, going back to empires and prior, in history overall, what you find is that the biggest reason that causes a central bank or a government to really be worried about their debt, it's not the actual level of debt relative to GDP so much, but actually when you have a high level of debt to GDP, accompanied by the fact that you also paying a very large amount of interest payments relative to your economy. And so what happens is you're basically having to grow your economy every year just to pay down your debt. And that's basically what the US is about 5% of their GDP is just to pay down debt. And so that is unsustainable. That's when you're really, basically exponentially growing your, if only on the interest payment alone, you're actually driving your debt to grow at a 5% rate. And then on top of it, you're also throwing in another massive fiscal agenda. Well, that's obviously going to have a major issue on your debt. And so, yes, we're seeing this government shutdown, and that gets a lot of noise, but that's, I sometimes try to just, mute out the noise and focus on the big picture. The big picture is right in front of us, is that the U.S. government and the Federal Reserve are likely to catch up on the Fed cuts, in my view, as we're seeing starting to get priced in more and more in the markets. I still shocked, if you ask me, I'm shocked by the level of the 2-year yield. I still think the 2-year yield has a lot to fall, just given the fact that how much we have of an affordability issue of the government debt to GDP today. And as we see that being reflected in the credit markets, I think that the Fed is going to be forced into a fiscal dominance position to reduce the interest payment to GDP. And so, what would that do to the next chart then, of which, if you think about it, to me, that's what it looks like, the support that you're seeing in the next slide. And this is, obviously just a joke. But if you go to the next slide, if you go to the next slide, that's it. That's basically the support that you're seeing. It's a long line that goes all the way back to 2010, 2011. And it's basically a line in the sand, in my view, of which, yes, we're seeing some, digestion after hitting that support, which is, it should be normal. In a normal world, you should see some level of digestion, of which makes a lot of people draw an arrow and say that, oh my goodness, we're now going to see a major support and the dollar is going to enter a midterm or a medium-term cycle, and we're going to go a lot higher. And certainly anybody here, nobody has a crystal ball. Nobody knows what exactly is going to happen here. But you also have, we can all have our own views. And I'll tell you my own view. And my own view is, and I think it's certainly Crescat's view too, is that this chart is going to break down, and we're going to see, once we see that break of this once, and if, of course, I have to say that, but if we see this break of this of this support, I do believe we're going to enter a long-term declining trend for the U.S. dollar, and I think that that's what catalyzes a lot of things. Catalyzes the situation with the mining companies, with the smaller companies and earlier stage companies that we have. We like to see there's small companies, but they're not really small. They actually have or are onto what we believe to be major discoveries of gold, silver, and other minerals. And what is interesting is that those things have not received the same level of liquidity as the other part of the industry yet, in our view. And that's one of the reasons it has to do, I think, with the dollar. The dollar has not confirmed yet this big downward trend. And I think we're very close to it. I think we're very, very close to it. I mean, one bad data or news, piece of news could really change things from a support to a break of that support. And then things would be, we would be in a very different world, in my opinion. So, when you start seeing people really positioning themselves the other way and taking long duration bets of a lower dollar is what is key. Anyways, let's go to the next chart real quick. So the next chart is something that's been happening is this crazy move on gold. And boy, what I said is if I could earn $1 every time somebody tries to time a correction in gold, I think we will all be filthy rich. And it's just a difficult market to be trying to do that because there's so many imbalances in the world. And even myself, I've tried to go back and say, all right, well, let's try to understand what happened in the 1970s and draw some level of guidance, right, to understand what we could see here. But the truth is that 1970s was nowhere close to the amount of imbalances we have today. We're dealing with something significantly worse than we saw back then. We're dealing with a structural problem when it comes to the current account deficit. We obviously have a fiscal deficit issue. We have a debt problem that we didn't have in the 1970s. And we do have the same issue of an inflationary era, in my view, that we saw back in the 1970s. You can say that they're behaving differently and be so critical about it. That's fine. But inflation is inflation. It's affecting consumers in all sorts of ways. And commodities are starting to move. And you're seeing different commodities at different times performing well. The dynamic that we tend to see in terms of commodities rotating, it's certainly happening. Right now we're seeing metals actually do very well. Not too long ago was oil, and so these things are changing quickly, and I don't think it's the end of it. I think it's actually the beginning. And I would say that if central banks are really serious about accumulating gold, of which I think they are, you have to think about that those institutions are not really considering overbought indicators. I mean, that's way too simple to analyze this market. I mean, that's just not the way a central bank, makes decisions. And if you're trying to understand a gold market, you better understand the large capital allocators driving the price here. And if their own way of measuring risk and making decisions has something to do with technical analysis, and I know I'm doing technical analysis as I talk bad about it, because the chart on the screen does have a big line in the breakout, but all I'm saying is it's a very difficult game to be trying to time the market in that sense, in my opinion. So I'll be careful with that. Let's go to the next chart. The next chart is a chart that I've used before, and I like to say that this is a defining question for the U.S. It's a defining question because if you look at what's going on, there's so much to unpack in this chart. You look at the end of the gold standard and how the blue line more recently, since the global financial crisis, has started to go higher. That's your international central banks buying gold, and they're reporting. This is reported numbers. We don't know what's happening unofficially at the highest level in 49 years, basically 50 years. Okay. The yellow line, on the other hand, is at its lowest level in 90 years. And so, the U.S. still has a lot of gold. I think everybody knows that. We have a lot of gold. We don't know how much China has. But what is important is that back in what is this, 1957? That's a long time ago. You can see here that we used to have actually 53% of the world's global reserves would come from the U.S. And now it's only 20%. So the U.S. has basically opted out, as far as we know, from this whole buying spree. And the defining question is, will the U.S. join the party? Or I'll add another one. Is the U.S. already joining the party here? And we don't know about it yet. And I think there is a chance that could be the case. Why would you not, consider that as potentially being part of this whole story? So, yeah, I think that this is a critical situation we're seeing in the macro environment. And one of the reasons why it is very difficult to be analyzing this market with the lenses of technical analysis. One more time. Let's go to the next chart. The next chart, we're basically looking at silver relative to financial assets, or the S&P 500. And this is total return on the S&P 500. And you can see almost a perfect cycle, right? I mean, we go up, and in this chart going all the way back to 1985 or so, when silver was overvalued relative to U.S. equities in a major downward trend all the way down to the bottom of the early 2000s, late 1990s during the tech bubble, which was the peak of the S&P 500 really outperforming silver. And then silver takes on to another major performance relative to the S&P 500. And how incredible is this chart now, doing exactly the same, starting to form a base, in my view, and potentially unleashing the beginning of an upward trend that could be extremely important for capital allocators. And so I do think that once we've been to and the reason why these things work that way, in my opinion, has to do a lot with conditioning of investors. We go through like 2 decades or so of one certain thing working. It's like CFA changes its own curriculum, and you see all these, universities changing their own curriculum, and that's a time when you want to be taking the other side of it, of considering what actually happened 2, 3, 4 decades ago, and thinking about the cyclicality that tends to happen over the long term, not about 5 and 7 years, but really go back a lot further and start considering that these things a lot of times have a lot to do with major changes of capital flows. And I think, if gun to my head, I really think this is the beginning of a period where hard assets should start performing better than financial assets. All right, let's go to the next chart. On the next chart, you're looking at what happened basically 3 days ago, which was that silver prices in quarterly candles made new highs. The close was around $46.50 per ounce. Today we're hitting for the first time since 2011, $48. We're not too far from the $50 that we reached, but from a quarterly close perspective, this is all-time highs on silver. And what I find why do I like to look at quarterly, and why do we all look at quarterly closes? For many reasons, is because when you get, usually you get a quarterly close, you're probably that's probably your leading indicator to see then a monthly close, and then you see your weekly close, and then you finally see your daily close. I do think that's going to be the case here. I think that there's a major technical case to be made about cup and handles. That is a formation historically that I would not bet against it. I think that's something that is clearly taking shape here now, and it's used to be that we were missing that ending side of that handle, and now we're finally seeing the beginning of a major move, in my view, in silver prices. And wouldn't shock me at all to see a momentum being gained as we make new highs here. Let's go to the next chart. Next chart is that whole thesis about, we're going to go over a few charts that really show a little bit about the acceptance of risk idea. What we're seeing in terms of investors beginning to feel comfortable taking a long play on things like junior miners. And you're seeing here silver junior miners actually starting to outperform silver itself. It wasn't too long ago when people used to mock us and other folks that invest in the mining industry, that mining companies never make any money. And, that is right. And when the environment for metals is not very favorable, I don't think that's the case here. I do think what we're seeing right now is a big change in terms of that acceptance of risk, and investors are beginning to really consider leverage over metals. Consider the fact that a lot of these mining companies today are producing silver sub $20 an ounce, while silver continues to make new highs. And every dollar it goes up, you have to consider the fact that you're probably seeing big leverage on the free cash flow front of most of these companies. So it's something to be very much aware of. And I know junior miners, not all of them are in production. Some of them are early in producing stories, but a lot of them are actually just holding big chunk of metal in the ground, and nothing wrong with that. That's another long duration play on the metal as well, that tends to have leverage over silver prices over the long term. Anyways, let's go to the next chart. So the next chart, now you're looking at gold miners relative to gold. It's another form of seeing, and helping us to really gauge, are we at the end of this? Are we at the beginning of this? And I think the chart is self-explanatory on that front, but we're still 60, depending on how you look at ratios, you're probably close to 60, 70% lower than what we saw back in 2011. Now I want to remind you, 2011, the margins that we saw back in those times were nowhere close to the margins we're seeing today in these companies. And so, think about that premium. At that time in 2011, when we hit finally a peak of the mining industry, what we saw was that people were paying too much for what their businesses were worth, and that was the peak of the whole industry. Today, we're still, in my view, operating under the assumption that metal prices will go back to the $20 or $2,000 an ounce gold prices that we saw not too long ago. But it's valuations are really not reflecting where we are with gold prices now. So, in my opinion, that has a lot to do with this leverage play. Again, I always like to say this: leverage plays both ways. If gold prices are falling, you should expect that these businesses to get hurt more than gold itself, because they're taking on leverage and operational risks to perform. And so, I think if there was ever a time to be taking that risk today, it is today in terms of operational risk. So, I personally, and I think, of course, why we have a portfolio of companies here is because we also feel very compelled that given this long-term, favorable environment for gold, silver, and other metals, gives us more conviction and to stand along with these positions in this whole industry. Let's go to the next chart. Next chart is also showing something similar, just looking at the juniors versus the seniors. So you saw the run up of the seniors. That's where the institutions, the folks that don't really, have the time or the complexity of this industry when it comes to the earlier stage parts of it, which requires so much geology understanding and the technical understanding to discern what is a good and a bad investment in this industry. And then you get into the seniors, where the seniors have consistent free cash flow. You can much easier understand and discount their valuations and so forth. And if you look at this, we're starting to see potentially the beginning of a trend where the juniors are starting to outperform the seniors. I always like to say this: there's no such thing as a bull market, and then a bull market in a junior space of the smaller names, the smaller companies in the gold space. It's people like to say that the original meme coin used to be silver and so forth. And those, because it is true. It's the speculation that tends to occur when silver prices, gold prices really take on a long-term trend, and people start to really go crazy in trying to value small companies and the opportunity they could have at prices staying this high for the long haul. Well, you start getting to some absurd types of ways to value businesses, and so it's usual, and that's why you see those speculative manias. It happened in the 90s with technology companies. It's happening today with AI. Where people start. I joke about this, but it's true. Like if you looked at a mining company now and you see, all right, well, how do you value a mining company? Well, you look at a producing asset. You have the production profile. You know what that mine is going to be. They have this many ounces. Then you divide that by how many years of production. So you have all the years of production. And how do you calculate the free cash flow? Well, you got to have a view about where gold prices are going to be, or silver, or any metal. And what's funny about this is that majority of these projects are still using a backwardation calculation, right, for most of these models. And so you looked at most of these companies, any company really, Newmont, Barrick, they are all, the analysts that are valuing these companies and saying, well, this is the price target for this business. They're all using a backwardation model. And no, I don't believe that we should be using a backwardated projection for gold prices. And it all comes down to projections, right? I mean, you got to project something and what you believe gold prices will be. Let's just assume that gold prices will be at these levels for 10 years. What would be the valuation of these things? And to me, that's a much more still conservative, in my opinion, but much more, I guess, plausible way of calculating what a business is worth in this whole industry. So, anyways, in some of these cases that we looked at, some of these models have like 30% embedded decline in the gold price, which is crazy. I can't believe that that's the case. But anyways, that's just my opinion. So, do your own work. Let's go to the next chart. Next chart is showing something similar to what Kevin was saying in his side of the presentation, which, despite this big increase in share prices of most of the mining companies, some of them have doubled, tripled recently, but they're coming off very low levels, historically. I just showed you a chart of mining stocks relative to gold and so forth. And so they're coming off very low levels. But what's more important is, despite this appreciation in share prices, PE ratios of most of the gold companies actually have contracted because the earnings per share of these companies have actually outpaced the share price increase. So, that's really, really interesting. And this is usually what you have in an environment where gold to oil ratio and silver to oil ratio are the levels that we are seeing now. I mean, it's such an absurd, where metal prices are relative to the cost of most of these miners have. The cost structure to produce these metals is substantially lower in most cases relative to where prices are now. So, these companies are seeing pretty large increases in terms of their fundamentals. And I would say that the beginning of this appreciation of the share price was really due to the projections of earnings improving, right? People started estimated that the earnings would increase, but given the fact that we're in the middle of such a skeptical period where people are just really negative about miners, those projections are really still too low relative to the realized earnings that came in. So realized earnings are coming in higher than what the estimates are. And that's, if there's one thing that drives share price, is usually a low multiple on your PE ratio or free cash flow multiple. And you combine that with growth. Oh boy, that's where things get really crazy. So I think that's kind of the environment we're seeing right now. Let's go to the next chart, please. The next chart we're showing here, this idea, hard assets outperforming financial assets, given the fact, gravity at some point, works, right? I mean, it's things get too frothy. It's hard to continue to prop things up. I mean, at some point, a bubble can only be a bubble for so long. And so you're starting to see actually mining companies really outperform financial assets, which is really interesting. You can see here the S&P 500 since the COVID low. So, March 20. If anybody here was during that time, I was there. Kevin was there. Oh boy, man, the mining companies. It looked like I got to watch out my words here, but man, that was a brutal time. And we saw mining companies go down 40, 50, 60%, sometimes in a day. It was crazy. So those lows that we're showing in this chart here, they're the real lows. It was a dark moment in the world and in the mining industry as well. So the fact that we're actually outperforming the S&P 500 now is really interesting. It's interesting because I think it's the beginning of it. A lot of people are seeing this as the end of it. I firmly disagree with that, because I believe that hard assets are just starting to outperform financial assets, and most of these businesses taking operational risk to actually generate those types of hard assets are just starting to perform really well in my view. So it's a very exciting time for those that have been in the industry for some time and are comfortable navigating the space here. So anyways, let's go next chart. All right, so final comments here. It's going to be on oil, because it's something that I've been I've been waiting. I've been so patient, and it's something I believe so strongly, just because I do think that one of the things that is really mispriced in this market, outside of the risk and other things, is inflation. And we're seeing inflation in a lot of ways. And when you look at commodity producers, it's a good index calculated by MSCI index. And that's the white line you're seeing, of which has a lot of very heavy, I think 30+% weight in energy companies, integrated oil and gas companies and others. And what you see here is this major divergence between the white line and the blue line. And begs the question, I mean, these things usually tend to follow each other very closely. I really think, 12, 24 months from now, we're going to look back and say, wow, oil was really cheap. It's crazy. And that's my view. I think it's fundamentally cheap for many reasons. I think the world is having a lot of problems in terms of geopolitical risks and so forth, and that's not priced in the blue line at all, in my opinion. I also think that the positioning factually is one of the worst positionings. People are so bearish on oil. I recall when oil was at $130, $110 a barrel, everyone was talking about it. Now that it's at 60, no one wants to talk about it. It's fascinating. And so, and now everyone wants to talk about gold. That doesn't mean I'm not bullish gold or anything like that. I love gold, and I think this is really the beginning of a much bigger move. But I can't help but also pay attention to something that I think it's fundamentally cheap and historically, misaligned with what it tends to do when we are in an inflationary era, and we're also in a period that could be very beneficial for oil markets as well. And on top of it, the last thing I would say, if you go to the next chart, it's something to be aware of. Yes, if you looked at so basically we're looking at the number of drill rigs and the Permian, which is the basin that produces most oil in the U.S. and by far. And you can see here that the red line is showing the rig counts in the Permian, and then the white line is showing the oil production. And what you see here, first, there's a few things. One is I think we're starting to plateau here. Yeah. All right. And on the white line, you can see here, we're not growing to the same degree we were growing 5 years ago. That's, I think that's one conclusion. The second conclusion you can take here in the red line is that it's making lower highs. Sure. That's, probably because we see efficiency, and companies tend to use less and less drills to produce the same amount of oil, and over time that's starting to have an impact on how these things work. But pay attention not to that. Pay attention to the fact that it's been contracting by over 30% in the last 2 years. Okay, 30% in 2 years is not it's very unlikely to be. Because these companies are becoming more efficient in just 2 years. Okay, if anybody's going to make that case, I think you're out of your mind. That's my 2 cents. And I think eventually that's going to start driving the white line to plateau or even contract at some point. And once people start realizing that, the price is going to be ahead of that type of potential change in fundamentals of a commodity. And so I am paying very close attention to this. I'll also pay attention to the fact that we're starting to export oil to a degree that we haven't seen in a long time in the U.S. And inventories in the U.S. are at one of the lowest levels in history. So, we're getting oil out of the U.S. We have very low inventories, and you're starting to see these oil rigs begin to turn. So, yep, I am definitely on the oil bull train, alongside with, in very strong hands with natural gas. And I think this is going to be very positive for the energy space over the long haul. All right, I think this is my last chart. Please correct me if I'm wrong. And I'm right. All right, Kevin.
All right, thanks, Tavi.
Yep.
So we encourage you to reach out to Merrick, our head of investor relations, if you're interested in learning more about Crescat's hedge funds and our SMA strategies. We think it's yes, we're having a good year, but we think it's still very early in the cycle for our many of our core themes, especially our activist metals theme, as Tavi kind of walked you through a lot of the setup there as to why it's still early, and especially for the where we're focused on the exploration and development side of the market, where the majors have underinvested for over a decade now in exploration and building new mines. So you want to be in those companies that the majors are going to have to come by if they want to increase their production and continue these phenomenal growth rates that they have right now. But I don't know how sustainable it is if they don't have any new deposits to work with. Meanwhile, we're in this insane, valuation bubble in the U.S. stock market at large for large cap stocks, driven by this AI boom. And there's some great companies that are out there leading the charge, but but are the fundamentals sustainable? Are the valuations sustainable, or are they? Is this a bubble that's likely to unwind in true reflexive bubble fashion? Stay tuned. I think that's what it. I think that's what it is, and I'm determined personally to try to capitalize on this in some of our hedge funds here at Crescat and in all of our funds. Anyway, so do reach out to Merrick. His contact information here. Let us explain more about each of our strategies and how, if they potentially apply to you. There's still time for all these themes to play out in a big way, I believe. All right, we'll be back in 2 weeks, and Quentin should be with us with a lot of updates on our activist metals positions. So we'll see you in 2 weeks.
All right. Thanks, everybody.